Hello everyone and welcome to my YouTube channel. Do pensions confuse you? Do you think you're saving enough to fund your future retirement? If you're not sure about the answer, this video is for you. The reason why I'm compelled to make this video is as a result of a short sample study that I did with 50 people, and the results really surprised me. Now, the sample was made up as follows. 10 of the people were employed, 40 were self-employed. All earned between £30,000 a year to £120,000 a year, and all of them were between the ages of 30 and 50. I asked them two simple questions. Are you saving anything at all to fund your future retirement? And number two, do you understand the options that are available to you to fund your future retirement? Now, out of the employed people, 3 people responded no to the first question, i.e. 3 people did not contribute anything at all to fund their future retirement. And out of self-employed people, which was 40, 67% were not contributing anything at all to fund their future retirement. Against the second question, which was around funding or understanding the options available, 5 people out of employed people of 10, i.e. 50% responded, they do not understand the options or do not understand them well enough. And out of self-employed people, a staggering 72% said they do not understand what options are available to them to fund their future retirement. That was very surprising to me, and it meant to me that I could help by sharing my little knowledge on how pensions operate in this country and what steps you can take to ensure you have a peaceful retirement. Now, I understand the need for us to have a little bit more money now, and therefore sometimes we know how these things operate, but we say, okay, well, £100 a month is more valuable to me now than it might be in the future, so I might as well not contribute anything to pension. But trust me, you do not want to not understand how pensions operate, because against a little contribution, the future benefit is just massive. So here we are. There are 3 different kinds of pensions in UK. A state pension, a workplace pension, and a private pension. In order to obtain the state pension, there is only one basic criteria, and that involves again something called number of qualifying years. What qualifying years means is a number of years where you worked in the UK and contributed national insurance. If you're employed, you will contribute it naturally through your payroll. If you're self-employed, you will need to register through self-assessment, and you're either paying national insurance through your self-assessment account, which includes sometimes even voluntary contributions on top of the normal national insurance that you will pay through your self-employment tax return. Now, as long as you have 10 qualifying years, i.e. you have paid 10 years worth of national insurance, doesn't have to be in a row, you qualify for state pension. The maximum state pension that you can get currently is £203.85. It does go up every year with inflation and some other factors taken into consideration. In order to qualify for the maximum pension, you need to have 35 qualifying years. If you have anything less than 35, your pension will be prorated as follows. So let's say you only have 20 qualifying years. The pension that you will get will be 20 divided by 35, which is the maximum number of qualifying years, times £203.85, which I think works out to be about 116. If you only had 10 qualifying years, you will get 10 divided by 35 times 203 is equal to, I think, roughly £58 a week. So, as long as you have a minimum of 10 qualifying years, you are entitled to some form of state pension. The reason why I think this is important is because I do know people who only have 9 qualifying years, and as a result of which they missed out on the entire sum of money available to them against state pension. The second kind of pension is workplace pension, where whether you're employed or even if you're self-employed under a company structure, it technically means you're employed, you're entitled to a workplace pension. There are 3 key advantages to workplace pension. Number 1, they provide you with a big tax advantage, and we'll come to what that means in a minute. Number 2, if you are contributing, your employer has to contribute. It's mandatory that they have to contribute a minimum sum of money to you. That is free money in your pension. And number 3, which is a big advantage, over the number of years you contribute, the compounding effect kicks in, and the amount of money that you end up withdrawing when you're ready to retirement is much, much greater than total contribution that you would have made over the number of years you contributed to it. Now let's give you an example of how this works. Let's say you earn £50,000 a year and you decide to contribute 5% towards your pension, which equates to £2,500 a year. The deduction that you will see from your salary will be less than 2,500. I think in this case, if you're earning 50,000, it will be closer to 2,150, 2,160. Because had you not taken that pension, that 2,500 would have been taxed, and then you would have only taken home the net sum in your salary, which is, let's say, 2,200. But the pension credit you get is 2,500. Your employer has to provide you with the minimum free pension money. In this case, I think the UK government stipulates that a minimum of 3% is mandatory for employers to contribute. But I've seen most employers contribute a more generous sum of money, in some sectors as high as 15-16% by the employer. But let's assume in this scenario that your employer also contributes 5%, which is another 2,500. In total, this equates to £5,000 a year going into your pension pot. Now, let's say that you started doing this when you were 25, and ignoring all pay rises and everything, you stuck to the same salary of 50,000, and you kept on contributing £5,000 a year for a period of 25 years up until the time you were 50 years old. That equates to a contribution roughly of 5,000 times 25, 125. But remember, you've only paid 2,500. Actually, you've only paid 2,200 a year times 25, which equates to roughly 55,000. So you have contributed £55,000 over a 25-year period into your pension pot. However, so has your employer. Now, with any decent rate of return, let's assume an 8% rate of return, because these pension funds are invested into different markets, and S&P 500 has been tracking at 8 to 10%, and so on and so forth. They have a very complicated strategy of how they put your pension funds to use. It's very reasonable to assume anywhere between an 8 to 10% return, and let's assume that you make an 8% return on your pension fund by the time you've invested from 25 to 50. As a result of compounding kicking in, you're likely going to have a pension fund ready of anywhere between £800,000 to £1,000,000 or even higher. That is a substantial sum of money against only a roughly £55,000 contribution. This is how important contributing towards your pension is. Where else would you be able to make £1,000,000 with a £55,000 investment? I mean, this is better than a cryptocurrency return, and it is far less riskier and almost like a sure shot return that you're going to make. So in order to fund your future retirement, there is only one advice that I can give you. Please do not ignore pensions. I have seen so many people around me who just out of laziness or not taking the appropriate action are not contributing in their pension. And trust me, this is going to come back to hurt you when you retire. So please take this seriously and do contribute towards your pensions. The last kind of pension is something called the private pension. So if you're working as self-employed, not under a company structure, you can decide to contribute privately. So there are pension funds that are available. You can check with your bank, and there are other resources on the internet. Just pop in private pensions, and there are a number of institutions that provide you with that option. They work very similar in the essence that, of course, the funds are going to get invested, and therefore you will see the compounding effect. However, of course, there's no one else contributing towards that pension. It's only you that will be contributing. Even if you have a workplace pension and you're entitled to a state pension, you can top up using a private pension. There is no regulation which stops you from contributing more to your pension. So, in a nutshell, please pay enough consideration to this. Understand this quite well, because this could be the difference between you having a peaceful retirement or struggling for money. A couple of other factors that I think are very important in the end to sum up. You're only entitled to state pension when you're 68 years of age. But workplace pensions can be withdrawn a lot earlier. In some cases, 55 years of age, and you can take a part of that pension out, even if not the entire sum. And there are different ways you can withdraw your pensions. You can take part of it lump sum, or you can actually create an annuity, which means you can get a certain sum of money every year up until the time you're living on the face of this earth. So please do take time to understand how pensions operate. I will leave a few links in the description below for you to understand this better. And in case you have any questions, please feel free to ask. Last but not least, this is not financial advice. This is an educational video. So please share, like, subscribe, and press the bell notification so you can get to hear more about things like this. Thank you, and thank you very much for listening.